Welcome to the video. First, we will introduce the hidden tax trap that can occur when consolidating retirement accounts, specifically when combining a rollover IRA with a backdoor Roth IRA strategy. We will frame the issue, preview how the Pro Rata Rule works, and explain how a common rollover decision can cause unexpected taxes. Then, we will outline a practical action plan to fix it and show you when the backdoor Roth is actually necessary. Next, here is our agenda. We will start with the big picture of the backdoor Roth IRA, then explain the Pro Rata Rule. After that, we will cover the rollover mistake that often triggers taxes, followed by the year-end reverse rollover fix. Furthermore, we will discuss when the backdoor Roth is necessary. Finally, we will walk through examples, diagrams, and short quizzes to reinforce the concepts. To begin, the key idea is that the IRS treats all non-Roth IRAs as one combined pool for tax purposes. This includes traditional IRAs, SEP IRAs, simple IRAs, and rollover IRAs. Consequently, if you attempt a Roth conversion while any pre-tax balance exists in this combined pool on December 31st of that year, the Pro Rata Rule applies and makes a portion of your conversion taxable. Now, let us review how the backdoor Roth IRA works at a high level. First, you make a non-deductible, after-tax contribution to a traditional IRA and document that basis on IRS Form 8606. Second, you convert that contribution from the traditional IRA to a Roth IRA. The goal is to have no pre-tax IRA balance on December 31st of the conversion year. If you maintain a zero pre-tax IRA balance at year-end, the conversion of your after-tax contribution should be non-taxable. If you have any pre-tax balances in any non-Roth IRA on December 31st, the Pro Rata Rule will cause part of the conversion to be taxable. Next, the Pro Rata Rule divides your Roth conversion into taxable and non-taxable parts based on the ratio of your after-tax basis to your total IRA balances across all non-Roth IRAs on December 31st. If you hold any pre-tax amount at year-end, the conversion is not fully tax-free. The solution is to ensure that your pre-tax IRA balance is zero at year-end before converting. Then, consider this example. You contribute $6,000 after tax to a traditional IRA and plan to convert that amount. However, you also rolled a former employer 401k into a rollover IRA, leaving you with a $100,000 year-end non-Roth IRA total balance. Under the Pro Rata Rule, only a fraction of your $6,000 conversion is non-taxable. Specifically, $6,000 divided by $100,000 equals 6%. 6% of $6,000 is $360, which is the non-taxable portion. The remaining $5,640 becomes taxable income in the year of conversion. After that, recognize the common mistake. Many people roll a former employer 401k into a rollover IRA to simplify accounts. If they then proceed with a backdoor Roth conversion in the same year, they will have pre-tax funds sitting in an IRA on December 31st. Consequently, the Pro Rata Rule applies and generates a tax bill. The proper approach is to remove pre-tax dollars from the IRA pool before year-end. Here is a quick quiz. Which situation most likely triggers the Pro Rata Rule during a backdoor Roth conversion? Option A. You have zero pre-tax dollars in any non-Roth IRA on December 31st. Option B. You hold pre-tax dollars in a traditional, SEP, simple, or rollover IRA on December 31st. Option C. You contribute directly to a Roth IRA under the income limit. Option D. You keep old 401k funds in your current employer plan. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Holding pre-tax dollars in any non-Roth IRA on December 31st triggers the Pro Rata Rule. The IRS aggregates all non-Roth IRAs as one pool, so any pre-tax balance at year-end causes a portion of your conversion to be taxable. Moving on, here is the year-end fix known as a reverse rollover. Step 1. Confirm that your current employer plan accepts incoming IRA rollovers. Step 2. Request a reverse rollover of all pre-tax IRA dollars into your current plan. Step 3. Ensure your IRA pre-tax balance is zero before December 31st. Step 4. Only after confirming a zero pre-tax IRA balance should you execute the Roth conversion of your after-tax contribution. Step 5. Maintain records including account statements, plan confirmations, and IRS Form 8606. Furthermore, timing is critical. Begin the verification and initiation process well before year-end, because transfers can require several weeks. Do not perform the Roth conversion until you have confirmed that your pre-tax IRA balance is zero. Document all steps and keep confirmations for accurate tax reporting, including filing Form 8606 to track basis. Here is another quiz. To keep your backdoor Roth conversion tax-free, what must your non-Roth IRA pre-tax balance be on December 31st of the conversion year? Option A, less than $1,000. Option B, exactly the amount you plan to convert. Option C, $0. Option D, any amount as long as you file Form 8606. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C. A zero pre-tax balance across all non-Roth IRAs on December 31st is required to avoid the Pro Rata Rule taxing your conversion. Now let us compare direct Roth contributions to the Backdoor Roth approach. Direct Roth contributions are permitted only if your modified adjusted gross income is below the IRS income limit for the year. They are simple and do not involve pro rata concerns. In contrast, the Backdoor Roth is used when your income exceeds the direct contribution limit. It requires two steps: an after-tax IRA contribution followed by a Roth conversion, and it requires a zero pre-tax IRA balance on December 31st to avoid taxation under the Pro Rata Rule. Next, determine whether the Backdoor Roth is necessary in your situation. If your modified adjusted gross income is below the federal limit for the year, you can contribute directly to a Roth IRA and do not need the backdoor process. If your income exceeds the limit, you may consider the Backdoor Roth, but only after ensuring your pre-tax IRA balance is zero on December 31st to avoid pro rata taxation. Always confirm the current IRS income and contribution limits, coordinate with your employer plan if a reverse rollover is needed, and maintain accurate records including Form 8606. The included markdown quick reference reiterates the decision path and the pro rata formula. Then, here are the key takeaways. First, the IRS treats all non-Roth IRAs as one pool. Second, if you hold any pre-tax dollars on December 31st, the Pro Rata Rule will tax part of your conversion. Third, fix the issue before year-end using a reverse rollover to move pre-tax dollars into your employer plan. Fourth, use the Backdoor Roth only when your income exceeds the direct Roth limits. Fifth, keep documentation and file Form 8606. In summary, the Backdoor Roth strategy can be highly effective, but is sensitive to pre-tax IRA balances at year-end. Avoid rolling old 401k funds into an IRA if you intend to perform a Backdoor Roth in the same year. If you have already done so, use a reverse rollover to your employer plan before December 31st to bring the pre-tax IRA balance to zero. Use direct Roth contributions when your income is under the limit. When uncertain, consult a qualified professional to tailor the approach to your circumstances. Finally, a brief disclaimer. This video is for educational purposes only and does not constitute tax, legal, or investment advice. Tax rules, plan features, and income limits change over time. Before taking any action, consult a qualified tax professional and review your employer plan's rules, including acceptance of incoming IRA rollovers and processing timelines. Thanks for watching. If this helped you avoid a surprise tax bill, please like the video, share it with someone who is planning a Backdoor Roth, and subscribe for more practical financial guidance. Share your questions and experiences in the comments so we can help each other learn.